Good day viewers, you're watching Business Television India. I am Sriram Iyer. Today the Nifty is up less than 0.5%. This despite the pressure from PSU banks who've gone down on a spiral, down over 2%. I'm talking about the index here. Individual stocks are seeing sharper cuts. Good global cues and strong market liquidity could not lift the spirits for investors in PSU banks, leading us to ask the question why. Friday afternoon, SBI reported its fourth quarter earnings, and on the face of it, the standalone profit had doubled from a year ago. The gross and net bad loans were down, but the stock wasn't excited. Because if you add the earnings of the subsidiaries that got merged into the bank from the 1st of April to 2017, the India's largest lender had posted a loss of 370 crores. Dig a little deeper and you will find that there was a spike in the loans under watch list, largely because of the subsidiaries that were merged into the bank. If indeed the quality of assets with the subsidiaries is so bad, why are the shareholders of SBI paying the price for it? And now that it is through and the shareholders will have to live with it because they voted for it, how much lower can the SBI stock go? To discuss this, we are now joined by Hemendra Hazare, independent banking analyst, and Manish Oswal, equity research from PCG department from Nirmal Bang. But first up, let's listen into the chairman, Arundhati Bhattacharya, to set the ground for this debate, and we'll take this forward in just a minute from now.
The watch list is 1.6% of our combined asset, whereas last time it was around 2.3%, I think, or a little more. So to that extent also, definitely it looks better. On account of the back of demonetization, we had a huge amount of deposit accretion. More than 60% of the deposit still remains in the system. So to that extent, we are not stressed for deposits.
Okay, so let's bring in Shail Damania here, our research analyst for banking, our news editor as well. Shail, the question, it begs the question, what is going wrong with SBI? And if indeed the concerns are so steep, let's first take a look at what the brokerages are saying and what are you picking up from them?
Right, so definitely if you look at the kind of responses from the brokerages on the back of the earnings which were released on Friday, and you'll see that when the earnings were announced, there was no major kind of reaction on the stock, but today we are seeing the stock slide further as the brokerages have pointed out that the subsidiary numbers which have been released on Friday, there are a few concerns as far as asset quality from their front goes. So let's take a look at what they're saying. Jefferies has gone and said that slippages will remain elevated in FY18. They've gone and cut FY18 consolidated earnings estimate by 11.5%. They've gone and cut FY18 the earnings estimates also by 2.5%. And the bank will have to raise additional capital from the market. This was largely known, but this is also what they pointed out. And key risks, weak asset quality and weak loan growth as well. CLSA goes ahead and says that the parent is steady, but the subsidiaries have disappointed. This is the title of their report as well. Subsidiaries, 16% of loans and 60% of slippages, that is their contribution to the earnings that we have seen. The subsidiaries impact will also keep cost of credit high, is what CLSA says. And they've gone and cut estimates citing subsidiary impact. They've also said that they're disappointed by the subsidiary NPA cleanup. And the standalone NPA is amongst the best in PSUs as well. So, Sriram, when you're looking at the view coming in from these brokerage houses, although most of them, I must say, have maintained their buy recommendation, few of them have cut price targets, some of them have increased them as well. But definitely, if you'll see most of them, there is always a mention of the impact that the subsidiaries have had on the parent company.
Indeed, I mean, we are talking about India's largest bank. I mean, if something is wrong with the SBI, needless to say, the other banks are in much deeper pain, much harsher pain. And which is why, I mean, even the brokerages, I assume, would take a rather cautious call before, in order to avoid any kind of panic selling.
Right, Sriram. So also another thing I would like to mention that the numbers which are, being spoken about, 6,000 crore is the impact on the overall numbers as far as profitability goes for the fourth quarter, which is the impact by subsidiaries, and for the full year it's approximately 11,000 crore. So these are the numbers which are being spoken about.
This 11,000 crore is the figure for?
The subsidiary loss for the year.
The loss for the year. 11,000 crore rupee loss coming in from the 5 subsidiaries on SBI's books.
No, and that's it's also important to mark out that this does not, when we say subsidiaries, it should not include SBI Life and the others.
Yes, and possibly that's the only bright spot.
Yeah.
I mean, if at all they were to raise money, it has to come from the SBI Life and not anything else, not State Bank of Bikaner in Jaipur, not Patiala, not anywhere else, or not Mysore. But aside from SBI Life, we are talking about the 5 subsidiaries that were merged into State Bank of India from the 1st of April. It was a government decision which was supported by the shareholders, and again, the shareholder being the government itself, the majority stakeholder in SBI. It raises a lot of important questions, and to answer those, or probably to raise those questions, to echo the views that are going to come in here, we are now joined by Hemendra Hazari, the independent banking analyst. Mr. Hazari, thank you for joining us here on BTVI. How serious is this concern? How do you see these numbers? Is there a reason for panic, or or not?
See, it is a matter of gravely of concerns of corporate governance, of lack of transparency in SBI's fourth quarter results. And definitely there's a concern about the asset quality of these subsidiaries. Now, overall, SBI can absorb it because the kind of consolidated operating profit it does have, the region of about 60,000 crores, it can absorb these numbers over time. But the issue is when you announce your fourth quarter results, you provide 2 detailed PowerPoint presentations, you issue a press release, and nowhere in all these documents is there the figure given of this fourth quarter consolidated net loss. So this is a major issue of lack of transparency. You give a consolidated full year number, which only analysts after deducting the 9 months we come across this figure. Now the issue is, you should have discussed and disclosed this upfront, the fourth quarter loss, and you should have given an explanation and a commentary. There's absolutely no commentary by SBI senior management on why this loss occurred, how do they plan to tackle it in future, how long will it persist. So this reflects very, very poorly on the SBI senior management.
Mr. Hazari, also another question is, from the start, when the whole merger issue of the subsidiaries into the parent company was raised, with that decision, what is your view? It's clearly happened now, but if you were asked, let's say 4 months or 6 months ago, then what would your view have been? Was it a good step to clean them up in this manner?
I have always maintained that it was a very rash move by the government of India, unfortunately supported by the Reserve Bank of India. Because for SBI to absorb 5 of their subsidiaries in one shot, it takes extremely difficult to digest. In my estimate, because of the reconciliation, just some of their pension liabilities would have cost them about 1,500 crores per subsidiary. Now, to me, it should have been done in a very gradual manner, one subsidiary every year. But this one-shot merger is going to have major impact, and we're already seeing this in the fourth quarter, where they're already showing how poor the asset quality was, which, mind you, neither did the shareholders of the subsidiaries were aware, nor were shareholders of SBI were aware, because all this has now taken place after the merger is done and dusted with. So if they had been reflected earlier, these numbers, the share price of these associates, which ones were listed, would have fallen sharply, and therefore shareholders of SBI would have been better off. Today it's the shareholders of SBI who are paying for this. And how is it that the same senior management goes to the SBI associates? They have a common chairperson. The chairman of SBI is also the chairman of these banks. The managing directors of all these subsidiaries are really on deputation from SBI. Their treasury is integrated. Their systems are so common. So the senior management of SBI has to explain to the public what has transpired in this last quarter and the last second half of the year for the financials of these associates to deteriorate so sharply.
And also, if you look at the kind of earnings that these subsidiaries had posted before the merger, they had, to my understanding, declared reasonably high NPAs, few of the higher numbers that we have seen before the merger. So one would have thought that majority of the declaration would have already been through by then. But looking at these numbers, do you feel that the cleanup process may take slightly longer? Maybe this quarter is not the end of the pressure which is coming through in the parent.
Oh, most definitely, because with these type of numbers and the way SBI has hidden them from the public, I think this causes a great deal of concern, because I expect now first quarter consolidated numbers of SBI to not be very good at all, because such a thing, in my view...
I mean, at the end of the day, these numbers are out. I mean, you say hidden, but we have those numbers, all the research, all the reports that have come out, they have also put out those numbers. So hidden may not be the right word, just as a cautionary word of caution.
Let me explain what I mean by hidden. If you look at what SBI has disclosed, they disclosed the full year consolidated net profit of the year and the full year P&L. They nowhere from what I have seen have they disclosed the fourth quarter consolidated profit and loss. Because if they had disclosed that, then everyone would have immediately known that this loss is there. And that is why if you see the media coverage on Saturday, nobody really spoke about this at all, because no one had realized this. Even I had not realized it. It's only when I went deeper, I realized that we have a problem here.
Okay.
And that is why I have deliberately used the word hidden. Because any bank, especially the standing of SBI that it has in this country, should have disclosed this upfront at its press conference, which sadly they did not do.
Okay. Let me take this conversation forward with Manish Oswal from Nirmal Bang. Manish, thank you for joining us here on BTVI. Do you also believe that the numbers were hidden, quote unquote? Okay, I think there is a problem with that line. We'll go back to him. But Mr. Hazari, the question then comes down to, I mean, how serious is, I mean, if the problem with the subsidiaries is so serious, the stock is near a record high. What is it that you're seeing that the markets aren't seeing? What is the difference of opinion there?
See, the difference is if the subsidiaries' earnings had an insignificant impact on the combined entity, I would have agreed that it is not material. But I think it's very clear now, if you look at the SBI standalone numbers in the fourth quarter and the SBI consolidated numbers, that there is a huge difference. And that difference is explained by the performance of these subsidiary banks, which has really eaten into the entire major SBI parent company, which tells you that actually the asset quality of the subsidiaries was extremely poor.
Okay.
It was not in conforming even with SBI's asset quality. So now the investigation has to start on why this has happened when the senior management of SBI was in direct control of these subsidiaries.
Okay. Let's. Manish is back with us on the phone line. Manish, you heard Mr. Hazari making his points there. Do you concur with him or do you want to disagree?
First of all, the SBI Associate Bank's quarter 3 performance also very bad. So it is not as a big surprise to the analyst community. All of a sudden there's a asset quality blip in the Associate Bank performance. Last 3 quarters they were reporting very poor number, and this quarter also they reported again very poor number in at SBI Associate Bank level. As far as the consolidated performance is concerned, merged entity of SBI plus SBI Associate Banks and Bharti Mahila Bank put together, the gross NPA level is 9.1%, and which is a very large number. And secondly, they have identified a watch list book of around 32,000 crores, which is 22,000 coming from SBI and 10,000 from associate banks for the merged entity. So overall, the performance of Associate Bank is below expectation, but that was last few quarter trend, not this particular quarter itself.
Okay. As we news flash that has come as we speak. Government plans to raise the number of MDs in SBI to 6 from 4. Government needs 2 more managing directors in SBI to manage the workload post-merger. Plans to raise the number of deputy MDs in SBI to 18 from 13. So clear acknowledgement of the fact that there is some problem and they need more hands to work on it. So is that enough for you, Mr. Hazari?
See, please understand that the SBI, the MDs who went as the MDs of associates are without jobs today.
Okay.
Right? And they came from SBI. So they have to be now accommodated within SBI at the top. So therefore, you see this expansion at the senior cadre. Now, let me also point out the point that was raised by my esteemed colleague about the numbers. In the third quarter, the SBI consolidated reported a net profit about 2,100 crores. And in fourth quarter, it turned out to be a loss of nearly 3,000 crores, which tells you very clearly that there was a very sharp and considerable deterioration in the associates and the subsidiaries of SBI in the fourth quarter. So although they have been performing poorly during the year, the performance suddenly becomes extremely adverse just after the merger ratio has been announced. And this is why I say that this is a corporate governance issue.
So I think the point that Manish was making is the fact that the associate performance was always bad. It was on expected lines. Am I correct, Manish?
Yeah.
So you are not surprised by the turn of events or the numbers that have been put out by SBI now?
Because in the last, post the quarter 3 numbers, minimum interaction, it was clearly indicated that the cleanup act will be there before the merger in the associate banks, and the analysts were building very high gross NPA number credit cost for the merged entity. So that is also the when you look at the consolidated estimates on the street, you come to know there is a high credit cost build up for the associate banks for FY17.
Point is that here I'm going to quote CLSA and not Mr. Hazari. They are saying that they have been disappointed by the NPA cleanup process at the subsidiaries. They probably there is more pain in store in the future. Is there an element of underreporting or rather sort of of the asset quality at the subsidiary level? Are you afraid of that?
So the total watch list number, which is 32,000 crores of NPA, and the SBI standalone slippage run rate is 10,000 crores. So, and if you look at the watch list NPA from watch list, which is 70%, so 3,000-4,000 crores coming from outside watch list for SBI standalone. Now, going by the watch list number of associate banks, so the consolidated merged entity slippage works out around anywhere between 13,000 to 14,000 per quarter. So we need to look at the quarter one performance and was this number of merged entity slippage number and the credit cost. Again, if you look at the credit cost for SBI standalone versus consolidated, standalone is 2.3%, consolidated 2.9%. So the credit cost for the merged entity will remain high for SBI in FY18, and the slippage run rate will be closer to 13 to 15,000 crores.
Okay, so you expect, I mean, you concur with the fact that the pain from the subsidies is going to reflect on SBI and therefore, and it is not going to go away for the next 1 year. And so I want to come back to a number that you quoted a little earlier, 9.1% gross NPA and 5.2% net NPA at the consolidated level for SBI, including the earnings from the associates. Now my question is, I want to know what is this number 9.1 compared to? What is the year-on-year figure if you have it handy?
This is gross NPA on the merged entity level I have. So right now.
Yeah. So what is the, do you have the comparable figure?
Yeah,
No, it's okay. I mean, if you don't have, it's fine. The question why I'm asking this is, I tried to look through the earnings release and I couldn't find one. And I think that's the point Mr. Hazari was trying to make, that if 9.1 is a number that we were given, and I got it from one of the research reports, but I couldn't find it in the earnings release, and I think our research team is still looking for it. So what is the comparable figure, Mr. Hazari?
First, I would just like to say that this number is there in the presentation. In fact, it's in there in one of the PowerPoint presentations,
so what
right at the end.
To 9.1?
Now, what it says, we can only compare 9.1 with the standalone SBI, which also has been given, which is 6.9. Now, mind you, the 6.9 is as of March 31st, and the 9.1 should be as of 1st April.
Yeah.
That is the comparison. That one has to be noted.
No, I'm saying comparable to SBI standalone numbers is okay. Within consolidated, as a consolidated number, 9.1 is up from what level?
So that we don't have as of
precisely
this, yeah.
My point. My point is that for me to say that the cleanup act is going on well or not so much, I need to know 9.1 is compared to a 7.5. I don't know. I'm just giving out an off the cuff number. If that jump is visible to me, if it is quantifiable, then it adds more credibility to these numbers, is all I'm saying.
See, very true. I think you've raised a very valid point, which is my main point here. See, one point is the concern over the asset quality, which is a separate issue. My concern here is that as the SBI manages India's premier bank, as very experienced bankers, they should do a full and proper disclosure with which a management discussion and a debate then can be enhanced. But here we get very stray data. We are now resorting to analyst expectations and analyst estimates, which is really not as credible if the SBI had just simply disclosed everything at the appropriate time. Now, mind you, if you look at the SBI full year, according to Bloomberg, they were expecting full year estimate of SBI consolidated at 6,900 crores, and SBI ended up with 240 crores. So there was a huge difference between what the analyst street was expecting on SBI consolidated for the full year and what SBI actually delivered.
So Mr. Oswal, the point that Mr. Hazari is making, do you want to respond to that?
So, I concede this thing as far as the State Bank of India's quarter four performance at the consolidated level, and especially the guidance or the trend in the associate bank is disappointing. That is number one, and that is very clear. So there is no debate in that. Number two, secondly, in terms of going forward, the outlook of asset quality, especially the merged entity, the outlook remain weak for SBI for at least FY18. So both the things and the credit cost will not see a major dip in FY18. So these are the things. So return profile of the merged entity will not improve. All those things are there in FY18 for SBI.
Okay. Okay, so we are entering the last lap of this discussion. I think both points well taken. Manish on the one side saying that he expected these numbers to be bad enough, particularly from the subsidiaries and the associate banks. And of course, Mr. Hazari questioning the fact that the disclosures weren't enough to make an informed choice for the investors. Now, the last leg of this discussion, I want to discuss on the market as a whole, Mr. Hazari. The point is that this entire rally has been supported largely by the banks. I mean, they have PSU banks have led from the front. And today, if you are raising questions on the credibility of these numbers from India's largest bank, the behemoth the size of SBI, then are we to assume that there is a lot more dirt under the carpet for all other banks and there is really no light at the end of this tunnel?
So one really cannot make such a statement convincingly because we simply don't have the numbers. Just as we simply did not have any clue that the fourth quarter of SBI Associates would be so poor. But by and large, I think it very well tells you what is the state of the banking industry today. That the associates tended to be far worse than what everyone thought they would be. And this tells you that the pain is going to be there for some time. And I expect the SBI's first quarter of FY18 numbers also to be poor. So that will tell you that the pain is going to linger for some more quarters to come. Now, mind you, it also tells you that this whole government thrust on bank consolidation as a panacea for your whole asset quality problem, if what we have seen in SBI's fourth quarter consolidated numbers, this tells you that there is going to be a lot of pain when banks consolidate, because here SBI practically was consolidating with itself because they were managing these banks themselves, the systems were very common, and yet you ended up with these huge losses which no one thought. I think even SBI did not expect them to be so large.
Okay. So even SBI didn't expect them to be so large. Manish, do you think, I mean, as Mr. Hazari is saying, that this merger, PSU bank merger or privatization as a panacea for all the ills that this sector is going through will not work. So next time we hear an IDBI sellout or a merger, then whoever is buying it is going to see a further dent on the stock price, not a revival?
So the merger is not a solution for the asset quality improvement. That is very clear. And because asset quality impairment or asset quality issues linked to the not paying capacity of the borrower. So merger will not help at all. And it linked to the asset utilization levels improve and the cash flow improve of those customers or borrowers. So consolidation, it's another thing in the PSU sector, but the asset quality issue is totally different.
Okay. My last question really is that, considering, again, bringing back to the same point that this market rally, Nifty at 94.50 and above, stands on the strength that the PSU banks on a revival path. If that entire theory is shaken at its ground, then do you think that market is more wobbly and the correction could be steeper? Manish, this question was to you.
Yeah. I mean, PSU banks... currently looking the valuation and the earning trend and the asset quality trend, most of the stocks are valuations are higher than the fundamental value. So right now the risk reward is not attractive in PSU banking space. Per se, from the private side, the retail banks continues to do doing well, and the corporate side banks like ICICI and Axis, they are reporting poor numbers. So the risk reward is still not that attractive on those spaces also. So
quickly, one word answer, Manish. Where do you see, how low can the SBI stock go? That's the question we've been asking from the beginning of the show. As our topic suggests.
So in terms of price correction per se, the SBI will underperform to the market, and the downside could be at the level of 275 or 280 kind of things.
Much, Manish. I mean, for the kind of fears that you are expressing here, 270, a 20 rupee correction, what is it? I mean, after a 100 rupee rally.
No, but that is the rating I have on the stock.
Okay, so your Manish believes that the stock cannot go below 270 in the near term. Mr. Hazari, do you have a number for that?
I think it should retrace all the gains because
Okay.
the expectation has definitely not been met. It is much worse than what everyone was expecting. Therefore, should not only retrace all this 100 rupee gain that it had, but should go even lower than that.
Okay.
But then this market never operates with fundamentals, and our entire market has been operating with liquidity and flows. But fundamentally, I think neither SBI nor anything else makes real sense to me.